All right, let's talk about the invisible force that's quietly pulling the strings on your entire financial life. We're talking about everything from the car you drive to the house you live in.
I mean, have you ever wondered why that happens? You get a quote for a car loan one month, and just a few months later, poof, it's totally different. It feels kind of random, right? But trust me, it is anything but.
In fact, believe it or not, the whole thing boils down to one single, incredibly powerful number. This one rate is like the first domino in a long chain, and it sets everything else in motion.
So here's what we're going to cover. First, we'll look at the rate that rules them all. Then, we'll define exactly what it is. We'll get into the high stakes balancing act behind it, explain the ripple effect, and finally wrap up with why this all matters to you.
Okay, first up, let's think about the economy's command center. There's basically a master switch, a single lever that can crank the entire financial system up or dial it way down. And understanding this one rate is the absolute key to unlocking the rest of the story. So, what is this master switch? What are we actually talking about here? Before we can connect the dots to your bank account, we've got to define it because this one concept, well, it's the bedrock of the whole financial system.
Okay, the official name for this thing is the monetary policy rate. Now, here is the most important part. This isn't a rate for you or me. Nope, it's the interest rate for the banks themselves. It's the price they pay to borrow money from the central bank. Think of it like the wholesale cost of money, long before it ever makes its way to us.
You know, a really great way to picture this is to think of the central bank as the thermostat for the entire economy. If things are getting too hot, with inflation running wild, they turn the dial up to cool things off. And if the economy is feeling a bit chilly and slow, they turn the dial down to heat things up. And that dial, that is the policy rate. But here's the thing. Adjusting that thermostat isn't just a simple twist of the dial. It's a really high-stakes balancing act. This isn't guesswork. Central bankers are trying to juggle two very specific and often competing goals. And here's the classic dilemma. On one side, they need to tame inflation, keep the prices of everything you buy from going crazy. But on the other side, they want to boost jobs by making sure the economy is healthy enough for businesses to hire people. And that's the tricky part, right? The very tool you use to fight inflation can sometimes slow down job growth, and vice versa. So take a look at this. Most central banks want a nice, steady inflation rate, somewhere around 2%. But what happens when it suddenly spikes to, say, 7%? That means your cash is losing its value, and fast. The central bank has to act. So when the central bank sees that, they have to step in. And when they do, it sets off this massive ripple effect. Let's actually trace how that single change, a rate that only really applies to banks, eventually makes its way to all of us. So let's stick with that high inflation problem we just talked about. To fight it, the central bank decides, okay, we need to cool this economy down. So they raise the policy rate. Let's follow what happens next. And let's put a real number on it to make this clear. Imagine they announce the policy rate is going up by 0.5 percentage point. Now, that might not sound like a lot, but believe me, the domino effect it triggers is huge. Okay, so this whole chain reaction has a name. It's called the transmission mechanism. It all starts with the central bank's move. Right away, it gets more expensive for commercial banks, like the one you use, to borrow money. So what do? Well, they pass that extra cost on. And that's step 3. The rates on your mortgage, your car loan, even your credit card start to climb. That changes how we spend our money, which slows down the economy, and if everything works as planned, inflation and employment finally start to respond. So what does this actually mean for you? Well, it means borrowing money just got more expensive for everybody. That new car you were looking at, the mortgage for that dream house, yep, they just got more expensive. But on the flip side, stashing cash in a savings account suddenly looks a lot more attractive. Businesses see all this happening, and they might put that big expansion plan on hold or slow down hiring. The whole economy just takes a breather. Okay, but what if we flip the script? What happens in the opposite scenario when the economy's struggling and people are losing jobs? Well, the central bank does the exact reverse. They cut the rate to try and heat things up. So now the headline reads something like, Central Bank cuts rate by 0.25 percentage point. And the whole point of this move is to get things moving again, to make money cheap and get it flowing through the system. And as you'd probably expect, the results are pretty much the exact opposite of a rate hike. Borrowing gets cheaper, which makes it a really good time to buy a house or a car. This encourages all of us to spend and invest. Your savings account won't earn you much, but businesses see more demand, so they start to expand and hire again.
economic activity starts to pick up speed. All right, so we've seen how it works when they raise rates and when they cut them. Let's pull back for a second and look at the big picture here. What's the main takeaway? Why does this one rate matter so much? There's a quote that I think just nails this perfectly. The policy rate is the fulcrum, the pivot point on a seesaw. A tiny little adjustment on this one point can tilt the entire massive economy between growth on one side and inflation on the other. And really, that's the bottom line here. It all comes down to the cost of money. It doesn't matter if you're a student getting a loan, a family buying a home, or a big CEO planning an expansion, this one single rate set by the central bank ultimately shapes the price you'll pay. It touches pretty much every financial decision we make. Which brings us to a really interesting question looking ahead. In a world that's getting more complex every day with things like digital currencies and crazy global shocks, is this one single rate still a powerful enough tool to steer a massive modern economy? That's a huge debate happening in economics right now, and the answer, well, it's going to shape your financial world for years to come.